Hey, Dennis Tubbergen here with another economic update. Today I want to talk to you about debt, in particular private sector debt. And before I get to the Bloomberg article you see on the screen in front of you, I want to just preface the conversation that we're going to have today by talking about the fact that when you look at the money supply, 95% plus of all money that exists globally today is debt. So that's less than 5% of the money that exists today is actually bills or coins. Most of it is debt, meaning that it's only money as long as the person or entity that owes the money is able to pay it. As soon as they are unable to pay it for whatever reason, then money disappears from the financial system. So when debt is not paid, the money supply contracts. That's deflationary and it can lead to recession. Now, with that background, this is an article published by Bloomberg back in December. And I'll start reading from the top of the article. You can read along on the screen. Private equity firms that plunged headlong into subprime auto lending are discovering just how hard it might be to get out. A Perella Weinberg Partners fund has been sitting on an IPO of flagship credit acceptance for 2 years as bad loan write-offs push it into the red. It's hard to have a successful IPO or initial public offering if the company that you're bringing public isn't profitable. Blackstone Group LP has struggled to make Exeter Finance profitable despite sinking almost $500 million into the lender since 2011. And Wall Street bankers and privates say others would love to cash out too, but there's currently no market for such exits. And the years after the financial crisis, buyout firms poured billions into auto finance, angling for the big profits that come with offering high-interest loans to buyers with the weakest credit. At rates of 11% or more, there was plenty to be made as sales boomed. However, it's a couple really important points. First of all, in order for these high-interest loans to be profitable, the borrowers have to be able to pay back the loans. Now, however, the car sales are down. It says, the article says new car demand is waning, and all of these subprime lenders, like banks did with real estate back prior to the financial crisis, they have made loans to buyers that frankly weren't qualified to buy a car. The article talks about this. Delinquencies on subprime loans made by non-bank lenders are soaring toward crisis levels. Fresh investment has dried up, and some of the big banks, long seen as potential suitors, have pulled back from the auto lending business. To top it off, state regulators are circling the industry asking whether it preyed on borrowers to put them in cars they couldn't afford. Chris Gillock, managing director at Colonnade Advisors, a boutique investment bank, says, the private equity guys sailed into this thing with stars in their eyes. Some of the businesses have done fine and some haven't. And if you look at the chart here in the article, you see that the delinquency rate for non-bank lenders is now approaching 10% of all loans. So 1 out of 10 of these loans is now in delinquency. That is deflationary. We think that is a red flag that could lead to a worldwide recession. Now, this article from Business Insider shows that worldwide debt has continued to grow. This chart shows debt, non-financial, business debt, corporate debt, government debt, financial debt, and household debt. You'll see that each of those categories has continued to go up from 97 to 2007 to 2017. So worldwide debt levels are significantly higher than they were prior to the financial crisis. You can see that in 2007, represented by the purple bar on the chart, non-financial business debt was about $42 trillion. Today it's about $68 trillion. That's an increase of more than 50%. Government debt worldwide, from 33 trillion to 63 trillion, government debt has nearly doubled in the last 10 years, obviously unsustainable. Financial sector debt from 53 trillion to 58 trillion And household debt up about a third, from 34 trillion to 44 trillion. Keep in mind that when over 95% of today's money is debt, when debt rises to unsustainable levels and debt doesn't get paid, the money supply contracts, which is deflationary, which is recessionary. That's why, despite all the optimism around the economy worldwide, we remain skeptical. That's today's economic update.